Are you feeling stuck with your current mortgage or loan payments? You might be hearing the word refinance everywhere. But the real question is, does refinance actually make sense in Canada? In this video, I'll be explaining what refinancing really is and when it makes sense and when it doesn't make sense, and what you should be considering before doing it based on a Canadian's economy. Let's start simple because a lot of people get confused here. Refinancing means replacing your existing mortgage with a new one. It could be a higher rate, could be a higher mortgage amount, a lower, higher interest rate, a new term or amortization, or accessing equity as cash. Bottom line is your old mortgage ends and your new mortgage starts. Now, I want to be very honest with you. As of January 2026, most Canadians have interest rate that are lower than what's right now. A lot of home buyers are sitting around 2 to 3% or early 4% rates. Today's Canadian refinance rates are higher than that. So for most people, refinancing just to get a lower rate does not make sense in 2026. Why people still refinance? Most people refinance for strategy, not just the rates. Most common reason I see is high interest debt, accessing more equity for refinance, investment, paying off a partner, spouse, or family. Life changes, divorce, inherited, buyout, switch from a variable to fixed, or for stability. Right now, the number one reason Canadian refinance is to pull equity out. The equity is often used to pay off credit cards, line of credit, and car loans, reduce all over monthly payments. Even if the mortgage rate is higher, the total monthly cash flow can improve. This is the first thing I ask every client. Refinancing has costs, appraisal, legal fees, discharge fees, sometimes penalties as well if you're in a fixed rate. If refinance costs you $3,000 but saves you $150 per month, that's about 20 months to break even. If you're selling before that, refinance doesn't make sense. Big questions. Now, here's where refinancing can make sense. Let's say you're paying about $600 on a credit card, $400 on a line of credit, and $1,000 per month. If refinancing can increase your mortgage payment by $300, that takes $1,000 off your debt payments. You're saving $700. That's where people mess up. If you refinance, pay off debt, extend your amortization, then run the credit cards back up, you end up owing more, paying longer, and feeling stuck again. Refinance only works if habit changes, car loans, and low interest cards. Another mistake I see, rolling a low interest debt into mortgage. If your car loan is 3 to 4% and you're refinancing into a mortgage at 5 to 6% over 25 to 30 years, you might lower your monthly payments, but you pay way more interest on long term. Lower payments does not always mean better deal. Rate-based refinancing only makes sense if rates drop below your current effective rate and you plan to stay long enough to recover the cost. This requires a paperwork breakdown. Even refinance it's not a good or a bad by default. It's a tool. When you use properly, it improves cash flow, reduce stress, creates structure. When you use carelessly, it delays financial freedom and increases long-term costs. If you're thinking about refinancing, don't look at the rates alone. Look at the monthly cash flow, long term interest, your future plans. If you want a real breakdown based on your situation, reach out, book a call with a professional like me. The goal isn't just a new mortgage, it's a better financial position.